Can I ask everybody to please take a seat so we can start our program?
Congratulations.
Can you what? What?
No, my one. That was the one I started.
Oh, right, so
I guess
it's okay.
temporarily.
It's okay.
That's fine.
Can we pull the American flag on?
We don't have it.
Oh, gosh.
Well, we normally start the program with the Pledge of Allegiance, but we discovered that we don't have a flag in the room. So then they were trying to see if they could pull it up on the screen. But if, it's okay.
Yeah, I don't know if I could find it.
I mean, once you get on the internet, we'll just
Okay, you
go
know what,
over
we just won't start.
do the introduction, then we'll get
Yeah. It's okay. Mike, don't worry about it. We'll just do it today. I'll start with the invocation. Mike, don't. It's okay.
All right, get this.
Okay.
We'll get the flag ring on the president. Oh, the PCSD flag.
Good morning. Can I ask everybody to please stand? We're not going to do the pledge today, but I'm going to do the invocation. Good morning. As we gather today, let us take a moment to reflect on the spirit of collaboration and community that brings us together today. We are grateful for the opportunities to connect, share, and grow both personally and professionally. May this breakfast serve as a reminder of the strength we find in unity and inspiration we draw from one another. Let us approach today with open minds, innovative ideas, and shared commitment to the success of our community and businesses. May this time be filled with meaningful conversations, strengthened relationships, and new opportunities. As we get ready to celebrate Thanksgiving, may we remember those who are less fortunate and find ways to share our blessings with others. Thank you. At this time, I'm going to go around the room and I'm going to ask everybody to please introduce themselves. Thank you. I'll start. My name is Maura Kiernan. I'm the chairwoman of the Yonkers Chamber of Commerce, and I'm also a relationship manager for Orange Bank and Trust, located on Central Avenue in Yonkers.
Morning, everyone. Patrick Doherty with Sound Associates. And if your mic doesn't work, they probably pressed this button when you grabbed it. Just press it again.
Evan Walker, Graphite Metallizing.
Good morning. I'm Eileen Victory from PCSB Bank in Jefferson Valley.
Good morning. I'm Kathy Cannell from the City of Yonkers Department of Planning and Development, and I'm also a member of the Women in Business.
Jackie Radigan, Travelmation, a travel agency in Yonkers.
Good morning. Happy to be here to support the Chamber of Commerce, member of Women in Business, Helen Hinkle. Thank you. Hello? That's not the button.
Hello?
You're good. You have the green light, you're okay.
Good morning, Mary Bohr. I'm president of the Untermeyer Performing Arts Council and also the City of Yonkers historian. Speaking of history, Sherwood House, 340 Tuckahoe Road, is having their annual candlelight tours the first weekend in December from 1 to 4 p.m. It's always worthwhile. And the Untermeyer Performing Arts Council, first Friday in December, is having their annual community tree lighting. So come join us.
I got the red light.
Got it. Good morning, Michael Sabatino. I'm the Director of Constituent Services and Government Affairs for the City of Yonkers.
Good morning, Sean Brown. I am a member of the Women in Business and NYU Langone Health.
I'd also like to to congratulate Kathy Cannell as being an aide to the Grand Marshal for the 2025 Yonkers St. Patrick's Day Parade.
Good morning, Chris Janeski from JWI Group, Property and Casualty Insurance in Yonkers.
Good morning, my name is Serena Morrison, and I am from the Financial Empowerment Center in the city of Mount Vernon.
Good morning, everyone. My name is Ashley Britton, and I'm the program manager for the Mount Vernon Financial Empowerment Center located in the city of Mount Vernon.
Good morning, everyone. My name is Barbara Saunders, and I am the City of Yonkers Business Services Liaison.
Good morning, everyone. Jack Martinelli with Westchester Magazine and 914 Inc. Magazine. Happy Thanksgiving.
Hello, everyone. I'm Brian Harrington with Elizabeth Seton Children's.
Thank you.
Good morning, Rich McSpadden, Business Representative, Local 3, and Vice President with the Westchester Central Labor Body.
Thank you. Let's give everybody a hand. At this time, I'd like to introduce Lenny Caro, President of the Yonkers Chamber of Commerce.
Let's give our chairwoman a round of applause. Thank you so much, Lauren. I didn't realize that the bank is over 150 years old. None of these guys look over 100. So we really want to thank you guys for being here today and our members. This is what chambers are about. Networking, shaking hands, and being able to look forward for future business. And having companies like this beautiful bank, which has a great history, to come and be a sponsor, it's what we really appreciate. So you know what? I think without wasting any of your time, I'm going to bring up Mr. Lindsay to help us with the rest of the program. Thank you so much, Lindsay.
Good morning. Thank you, everyone, for being here this morning. It's an honor to be a host here for the Yonkers Chamber. I'm a member for over 20 years of my career in banking, and I thank Mike Goldrick for allowing PCSB to be a sponsor for the first time here in Yonkers. And it really shows you how we value the Yonkers community and we believe in the business here in Yonkers. So location is not what it used to be. Technology allows you to bank anywhere you would like to. So let that not be a barrier to me mentioning Mount Vernon despite being here in Yonkers. But it's an honor to be here with the bank and my colleagues who were here to join me this morning. Really appreciate the support. And my friends from Mount Vernon who came over this morning, thank you for being here as well. It's a way to introduce our businesses to the various communities because, once again, we're all connected in some way or another, right? So we have the same initiative and the same goals. So I'm going to introduce the bank president of PCSB Bank, Mike Goldrick. And Mike Goldrick brought me over from Hudson Valley Bank. Those of you in Yonkers and our long history we had in Yonkers, it's an honor to work for PCSB Bank with leadership and support like this. My manager, Dave Parks, is here also supporting PCSB Bank and myself. So I'm going to give you Mike's attention. And once again, learn about our history. There are flyers on the table, my business cards on the table as well. Any questions today or in the future, please feel free to utilize those resources to reach out to me. Thank you. And here's Mike Goldrick.
Thank you, Lindsay. Thank you, Maura. Thank you, Lenny. It's a pleasure to be here this morning. So thank you for having not only myself, but also PCSB Bank. And I love the introductions around the room this morning because there are a couple of faces that I haven't seen in a little bit. Brian out in the back and Mary Hoare. Mary and I were on the board together at Family Service Society of Yonkers quite a while ago, and Mary, I don't think I've seen you. Yeah. So despite, and some people tell me that I look a little bit younger than I really am, so, or maybe act younger than I should be, one of the two, I forgot what, most of it's my wife's comments. But just first a little bit about me. President and CEO of PCSB Bank. I'm a third generation banker. My grandfather was in banking at Franklin National Bank in New York City. My dad ran State Bank of Long Island out in Long Island. In January 2023, after about 10 years at PCSB Bank. With a little bit of a change, I did become president and CEO, spending most of my career as a commercial lender. A big part of that career was in the 1990s. I was with Hudson Valley Bank here in Yonkers at 35 East Grassy Sprain Road. Left Hudson Valley Bank for about 10 years, came back and was at 21 Scarsdale Road and a few other locations for Hudson Valley Bank here in Yonkers. So the connectivity to Yonkers and the community is very interesting, big part of my career, so happy to be here with the Chamber this morning. With that, today I'd like to run through a couple of slides. First will be a little bit of an overview of PCSB Bank, as we heard. Then we'll go through some things with regards to the general economy, the interest rates, and the current banking environment. So first, the slide with regards to PCSB Bank. And it's okay if you can't read all the dynamics, but it's basically I'll run through them. But if you look over on the left, the picture of the bank, Westchester County, Dutchess County, Rockland County, and there's another one, and Putnam County, of course. It's a little bit small, but there. But basically, 14 branches throughout those counties. Let's see, I have to refresh. As Lenny said, the bank is over 150 years old. We started in 1871 as a New York State chartered mutual savings bank. And we're pretty much a quiet savings bank for 150 years. In April of 2015, we acquired CMS Bank, which is headquartered in White Plains, and that furthered our expansion into Lower Westchester. In 2017, we converted from a mutual bank to a public bank, and right before that, we changed our name from Putnam County Savings Bank to PCSB Bank, as we were in multiple different counties, locations, or whatever. The acronym made a lot more sense than the Putnam County Savings Bank name. In 2019, we converted from a savings bank to a commercial bank, and then in 2023, we completed a merger into Brookline Bancorp as the holding bank. Brookline Bancorp, based up in Massachusetts, owns Brookline Bank, 30 branches in Massachusetts. It owns Bank Rhode Island, 15 branches in Rhode Island, and now PCSB Bank, 14 branches in New York. The good news about that is, despite the fact that we were acquired by a Massachusetts bank, we're still a New York State chartered bank working out of and headquartered up in Yorktown Heights. So it's a part of the holding company group, and we have our team and our group here. So the decisions are still made locally, but we now have we're now part of a $12 billion bank enterprise as opposed to a $2 billion bank. So the added technology and the infrastructure that we have works out a lot better as a $12 billion bank than a $2 billion bank. So their assets as of September 30th, $2 billion for PCSB Bank, 11.7 through the holding company. The 14 branches and headquartered in Yorktown. Next slide is just to get everyone a general picture in everyone's head about the economy and the economic cycles. Basically, four main cycles for the economy. One being early recession, the dark blue top, if everyone's looking, top right-hand corner. The activity slows and problems arise. The light blue on the bottom is recession. Contraction of the economy, contraction of business, troubled assets for the banking world. So a little bit of a mixture of talking about the economy, mixing the banking world here together. Then we move on to the gold, which is the recovery. The activity improves, everything gets back, and then all of a sudden we're into the gray, which is growth and robust activity. The cycle always works clockwise. The one thing that we can never predict or don't know is the time and duration in each of the cycles. So we're constantly moving as we go from cycle to cycle. Sometimes events happen. With COVID, Basically, I believe we jumped from recession to recovery pretty quickly, basically with the stimulus program. So I think we kind of shortcutted the gray session and moved from light blue to gold into dark blue pretty quickly, and then back again. But it's always going to be a cycle. We're always going to see that. With that, I'll then get into some general happenings that happen within the economy, but also within the banking world. Should be next slide. Okay. Then a few things that we're looking at within each of those cycles. Inflation. Inflation, definitely, as we're seeing now, with the following COVID, we ran the stimulus programs to basically put more money out there. Once that money was created, it was impossible not to have inflation. So all the work that's been done recently is how do we control inflation? How do we have a soft landing? So there was a lot being done over the last administration to protect that, make sure that the economy was still moving along despite the fact that there was a lot more money on the table. That money doesn't go away, it just gets absorbed into the community, so a little bit of inflation happens. What we want to keep away from is high inflation, rapid inflation, stagflation, all that. With that, basically, as inflation hits, the purchasing power runs out. And that purchasing power is more disparate with regards to the low-income community than it is for the middle and the higher-income communities. Because as those goods and the cost of goods increases, in that lower wage segment, it's harder to keep up with that pace. In the higher, middle, higher, they're usually backed up and supported by investments that are improving as well, and you have a little bit of a better background. So the important part is for the global and for the best of the economy is to keep that inflation number intact, and that's what we've been trying to do for the last little bit. With that being said, the next factor is interest rates, and a big difference between short-term rates and long-term rates. On the short-term side, you have in the banking world, you have prime rate and SOFR as the biggest indicators. On the longer side, you have the Treasury rates or you're pricing off Federal Home Loan Bank rate. In the past, we've had an inverted yield curve. Inverted yield curve basically being that short-term rates are higher than the long-term rates. Right now, the current prime rate is at 7.75. The 30-day SOFR is 4.84. The 5-year Treasury is 4.32, and the 30-year Treasury is 4.6. Just an indication, and a lot of people ask me and say, Mike, where do you get prime rate from? How is that based on? As we know, as you hear, the Fed sets the short-term rates. So basically, the short-term rate from the Fed, about 4.75 right now. The banks basically say for a good customer, borrowing off prime rate, for a very strong customer, it's prime rate. So that prime rate is 300 basis points over that short-term rate, hence you get the 7.75. So when you see and when you're hearing that the government, when the Fed is cutting rates, 50 basis points in September, 25 basis points in November, you'll see that prime rate come down to where it is right now. The interesting dynamic that happens is that because of the inverted yield curve, we're now seeing rates being cut on the short term, but the opposite's happening on the longer term. The 5 and the 10-year rates are popping a little bit higher because basically the short term's coming down. The Fed sets the short-term rates, the market controls the long-term rates. So the market is viewing the economy, viewing what's happening in the future as a little bit better, a little bit more optimistic, and basically popping those long-term rates. Those long-term rates are what we're pricing longer-term term loans or commercial mortgages off of. There's two factors that we're usually looking at, the Treasury rates and the Federal Home Loan Bank rate. Both those rates, anyone could go, you could look it up and find out where the 5-year Treasury rate is, where the 7-year, 10-year is, and knowing where that is. Banks traditionally price where prime rate is 300 basis points over the charted rate. The pricing off Treasuries or the Federal Home Loan Bank rate will range anywhere from 200 basis points to 300 basis points plus for the most markets, a little bit higher in the leasing market and the specialty markets. But those are the best indicators to look at when you're figuring out, okay, I'm borrowing, I need to go to a bank, what are my rates going to be at? Interesting enough, where I said the 30-year Treasury is 4.60, the current 30-year residential mortgage rate is about 200 basis points, 225 basis points above that. So right now, a 30-year mortgage is about 6.75. Varies a little bit from place to place and who's being more aggressive, but that's about where that rate is. The other interesting factor with regards to the rates is the risk that's out there in the profile. And I'll wait until I get to the banking page on that. We'll talk about that a little bit. So item number 3 on the unemployment and the personal income. The other factor is, as we know and as we've seen, the unemployment rate has been very low. So that is putting basically more money into people's pockets, more personal income, and having the spending power. That goes hand in hand with item number 4, which is consumer spending, which is retail sales, and leads to increased business productivity. Then the other key factor that we have impacting an economic cycle are all the global issues. A couple that I have listed here are everything from war, tariffs, weather, strikes, etc. A couple of years ago, I probably would have had pandemic first instead of war. But definitely this fact that major events such as global occurrences will impact the economy here and vice versa. And as we know, there's, leading with the first one, definitely some huge concerns with regards to the unrest in the Middle East and over in Ukraine and Russia. So we'll have to keep our eyes on that. The next slide. And I call this the PCSB Bank Economic Newsletter. But it's also the information that I kind of gave with regards to the economic factors and how does it impact the banking world. How do we learn about that other than coming to the chamber breakfast like this and hearing people speak and communicating with us? A great way to kind of keep up on what's happening not only locally in the community, but what's happening with PCSB Bank, what's happening with Orange Bank. I know Tompkins is usually here, Summa Credit Union right next door, but all those resources. Use your trusted advisors to keep up on what's happening and come to events like this as well as events for the BCW, WCA, and use those resources. But another resource that you have, and the good news is it's free, if you go to our website each month, we produce what we call the PCSB Bank Economic Newsletter. It's on our website, pcsbbank.com. You go to Connect, you go to Resources, and you go to Newsletter, and a couple other clicks, and you eventually get there. So it's hidden, but you can find it. So basically, in that newsletter, we kind of give a little bit of a recap of what's happened, basically during the past month, and things that we see happening in the different sectors. Case in point is in the most recent newsletter, and it's only 4 pages. So there's 3 pages of narrative, and then the 4th page is basically a history of rates and other economic indicators. So it's a really quick read. Snap on it. You're done in a couple minutes, and basically could use it and pick up a pointer on it. For example, in the most recent newsletter, in our November newsletter, basically we talked about the impact of the hurricanes on jobs and production. So big hurricanes, one down in the Carolinas, one down in Florida, and that's going to disrupt employment down in those sectors. It's going to disrupt activity down there. Same thing as when one of the boats hit the bridge in Baltimore and knocked out that port there. That disrupted the amount of goods coming in. Fortunately, not a lot comes into Baltimore, so it wasn't that big of a disruption. But events like that could happen with regards to shipping, weather, goods, and everything would be in there. Another big one, the Boeing strike, definitely having a temporary impact on employment and factors and productivity within the airline sector. And then it also hit upon the current rate environment. In November, basically had the 25 basis point cut. I believe our September newsletter basically led off with rates and the fact that we were expecting a cut. We weren't expecting 50 basis points, but 25 basis points, and Good indicator, good little heads up as far as the introduction. Section 2 basically spoke about the consumer and wealth, stating that growth was stagnant, but strong income and controlled inflation fueled spending, a good thing. And factor point that the mid to upper income sector accounted for 80% of total spending. So big, within a couple paragraphs, some good takeaways there in that section. In reference to housing, an interesting tidbit that the inflation is creating equity in the housing market, but that's offset by the fact that only 15% of homeowners have a rate greater than 6%, and HELOCs, which are based off the prime rate, are currently expensive at 7.75. So despite the fact that there is availability in equity in the homes, it's not being utilized. And the other factor that's happening is no one's refinancing a house. If you have a rate of in the threes, some fours, some if you have twos, great, even better, but you're not refinancing your home. You don't want to touch that. You don't want to touch that mortgage. If you have extra money, put in a CD, you get 4.25, 4.5% on a CD right now. So that money is staying tight, and you definitely don't want, unless you need it, going into the home equity market right now, because even if you're home equity, most programs range from prime rate is pretty standard. Some will have prime minus a quarter, prime minus a half, but that's still pretty expensive in comparison to rates in the pricing out there. The other thing that I wanted to mention about I know I had a point on the longer term rates with regards to the banking market and lending. Although the longer term rates are priced off treasuries in the Federal Home Loan Bank, the short term rates are bumping that up a little bit, because if the banks are paying 4.25, 4.5 on CDs, and the treasury rate market says that the rates are 3.6, 3.7 for a 5-year, or in that sector, it's a blended rate, because the cost of money to the banks is a blend of not only through the treasuries, but also through what we're paying out on the CDs, so it becomes a little bit more expensive. So just a little bit of a tidbit there. And then basically, Section D talked about the bond market. The fact that the short-term rates are being controlled by the Fed. We saw the rate cuts that happened. The market was predicting additional rate cuts. I'm not so sure that's going to happen now based on the new political environment, but that might have to wait until the next newsletter. And what I've said before is the longer-term rates being controlled by the markets, despite what the short-term rates are doing. The fact that we have an inverted yield curve, history says that yield curve will be corrected and will be up a little bit higher on the longer term, and we've already seen that starting to happen a little bit. And then item number E, which is the rate sheet. So a great one-pager, basically goes back with basically saying what the current interest rates are, as well as what the past was about a month ago. I think it dates back a year ago. So it gives a whole history of what some key rates are. So you could look at it real quickly at a snapshot and say, oh great, that's good history. The other resources too, in case you need anything else regarding additional data, regarding treasury rates. As you all know, a quick little web search will get you into rates and some history and some information, probably more information than we need to know. And then just have to clear out what's real news. Be careful with ChatGPT. All the information isn't always 100% correct, so you just have to research it and then verify. Slide number 5 of 50. So slide number 5, you have everyone's here for the day, right? Slide number 5, and it is the last slide. So the current banking environment. So the current banking environment, as most of us in the room probably know, definitely if you're involved in commercial real estate, the current lending environment in commercial real estate is restrictive, and restrictive for a couple reasons. Not only because of item number 2, but also because of the reasons up above. The office occupancy is being impacted by remote work. So the remote work, which basically isn't going to completely go away, it's there, but it's absolutely impacted office occupancy rates, which is going to impact the tenancy in the buildings and impact the gross revenues, which will then impact the net income and the ability to service debt. At the same time that's tightening the revenues and income on buildings and properties, we also have rate repricings. Most commercial rates for commercial buildings are set either on 5-year terms, 7-year terms, or 10-year terms, and then they reprice. Those rates that have repriced and that have been set in the 4s for the most part are now repricing out into the 6s, maybe even in the 7s based on where long-term rates are. So that extra 2 to 3% comes off the bottom line, comes less that the buildings can afford to pay for those mortgages. With that being said, the banks are all looking at, and most of the loan agreements state that your debt service coverage on that building should be 1.2 times or greater. As those rates and as not only your revenues are being squeezed by the occupancy, your net income is being squeezed by the additional expense of that cost of the interest rate, it's harder to hit that 1.2 times debt service coverage. So basically you then have loans that hopefully are paying better or debt service coverages that are better than 1, some that are less, but basically that's a tight squeeze. So with that happening, building valuations, which are basically valued on the multiple of what your earnings are, building valuations are being knocked down. Some buildings are getting in trouble. When those assets are then repositioned, that knocks down the sales comparison approach, so appraisals are coming in lower. So it's a kind of a snowball of a spiral impacting the commercial real estate world. So the banks are concerned about it and regulators are concerned about it, and it's basically making that market a little bit tough. On the bright side, the C&I, the commercial and industrial loans, are being encouraged by the banks, are being encouraged by the regulators. And a C&I loan can be real estate. If you're an owner-occupied building, that building's not a tenanted building. So the dynamics behind occupancy rates and how that business works, that's different from a C&I building that's dependent upon that tenant, that occupancy. A building that's owner-occupied is dependent upon how well that business is doing. So that's a little bit of a different sector. That's a C&I sector. So anything with regards to owner-occupied real estate, a business line, a credit facility, a term loan, all those are basically a stronger sector right now and are being favored by banks and favored by the regulators. So that market is somewhat dynamic. We then get into the regulatory environment. So the double whammy in the commercial real estate world is the fact that the regulators, for the most part, allowed bank commercial real estate concentrations to go over a ratio of 300% to 1 based on the capital. That's funny. So if you went over the 300% mark, which was common for most regional banks, basically all you needed to do was migrate some of your portfolio a little bit, make sure that you were diversified in location, make sure that you were diversified in asset type and asset class, anything from multifamily to commercial to big box tenants to mixed use properties. And as long as you had that diversification, you could point out and say, this is the reason that we're over 300 to 1 and we keep on lending. The regulators have said, nope, we want you to be 300 to 1 max or maybe even lower. So basically, that's forced banks' hands to say, okay, we're going to shrink our portfolio a little bit. For us, it's not necessarily shrinking. With our portfolio, we have runoff based on normal amortization and payoff. So just by replacing that, that keeps us pretty busy on a day in and day out basis. And we do have a little bit of room for growth. But some banks are basically pulling back in the commercial real estate market, which is causing things to be a little bit tight. And this is not only Westchester County, it's across the nation. The other thing that's happening is that debt service coverage that I mentioned. If your debt service coverage is 1.2 or greater, that's great. If it becomes a little bit tighter, basically the regulators are saying you have to downgrade your credit. So the credit still might be performing, paying as well. But if we have to mark down a credit, we basically then have to put more reserves into the system. That reserves take away from our capital. That capital impacts that CRE concentration ratio, that 300 to 1. If our capital gets a little bit less, that ratio gets a little bit tighter even if we don't do anything. So basically that's making that number even more restrictive and the lending within the banks a little bit tighter. So that's what's happening in the banking world with regards to commercial real estate. with regards to item number 3, very, very important, and a big takeaway. So the rest was some economic news that's going to happen. It's going to keep on going. It's going to change by the time I leave. By the time I leave the room this morning. So the important part is to keep up to date with whatever resources we're checking in on. Use things like the economic newsletter. However, really important is the security and the fraud protection that's happening out there in the current banking industry. And it's everything from whitewashing checks to falsifying emails. And then the two things afterwards are preventative, positive pay and reviewing online and statement monitoring. But just a little bit on the checks. Right now, basically, and everyone's heard about basically the criminals going to the post offices and stealing checks right out of the mail. They steal the checks. What they do is they then whitewash the payees and the amounts. They change it and they try to get that check through the system. Sometimes they don't even whitewash it. What they do is they take that check, and that check has the routing number and the account number. They put that check on the dark web and sell it. They sell that routing number and the check and the account number, and then someone just goes to a check stock, falsifies a check, tries to do an ACH pull or anything else like that because they have that routing number. So that's being done, whether or not they're stealing the check through the mail, stealing a copy of the check and trying to get it through the system. Fortunately, that's being prevented in two different ways. The bank's technology, as those checks come through, the banks have their monitoring systems, and they're picking up those checks before they get through. The other is something called positive pay. Positive pay is when you have, and it's for businesses, it's not personal, but positive pay is when you basically have your check files submitted in, and the bank knows every check. It knows who the payee is and what the dollar amount is, and that goes through the system, and it's verified. Not only that, there's also a double check back to the business owner, business CFO, controller, financial person to review that file every day and make sure it's legitimate. The only problem with positive pay is it's, one, a little bit labor intensive. Every small business owner every small business owner is the head chef, the head cook, the waiter, the busboy, everything through it. So to add that service in isn't always available to that small business owner because it's labor intensive on their side. The other thing is there's a little bit of a cost to it as well. So every small business owner can't afford it. What the banking industry is trying to do is to refine positive pay, to bring it down a little bit, making that more cost efficient so we can get out there to more small businesses, more nonprofits, so we have positive pay within that segment. If you don't have positive pay, but you're running a business and you still want to prevent that, the next best thing is basically looking at your statements, whether or not they're physical or online, and looking at that daily activity and just checking it. The big thing, we've seen it on the banking side, and what happens is the criminals will run a test, and sometimes you see an item as little as $1, as little as $2. They'll run $1 or $2 through, see if that gets picked up. If it doesn't, next thing it becomes $20, $200, $200,000. So that's what they do to run through. So any oddity that you see on your statement, call your banker. Go to your bank and say this doesn't look right or whatever, and kind of look at it. But that's the most critical. We're looking at it. The bank's looking at it in the back office. But we need, everyone has to be super diligent on that, super careful because of the whitewashing of the checks, because of the fake emails and the other fraud. The next biggest fraud on the email side of it is a vendor calling up your office and basically saying, "Oh, we switched banks. Send send the correspondence here or send the ACHs here." Double check, triple check, and make sure all of those things are legit. If someone in your office is running that, make sure they're aware of it and constantly looking at it. Oh, back to the beginning. So that's, and the other thing too is most of the banks and the financial institutions do have a fraud and a security page too. So with their current events and everything else like that. So if you do need more information, there's the credit card companies are doing it, the banks are doing it. So look at all that and heed to that advice. So out of everything I said with regards to one, the banking industry and history, just from a safety and security purpose, remind all your contacts that aren't in this room, friends, family, everyone else, just be really careful, especially in this current season where the amount of transactions that are going through the banking system are absolutely huge. Just to be extra careful and extra diligent on safety and protection. The last item I had in the bottom was basically the political environment, and basically wanted to say there, stay tuned for our December newsletter. Your guess is as good as mine. Good luck to us all with the new political changes and everything. But there is going to be some big changes on the positive side for the banking world. It'll mean a little bit less regulation, which I guess is good. And then on the rest of what's going to change within the administration, there'll be some changes. We've seen the stock market react to it. So far, so good on the positive side, but definitely more to come. So I'm sure our December newsletter will hit on that, as well as January, February, March, and afterwards. But once again, a pleasure to be back here in Yonkers. I was here in the early part of my career with Hudson Valley Bank. Happy to be back here, whenever you guys need, but an absolute pleasure, and thank you for having me.
Thank you, Mike. I'll ask Lenny to come up now so we can present a certificate.
I want to thank you tremendously. If some of you have paid attention, this bank works with you. If you listen to what they do, they go over and above to help you create your deals. And that's important because not everyone does that. But it gives me great honor to give you our award. It's called the Knife and Fork Award, but we ran out of forks and knives, so we're going to give you a certificate of award appreciating your sponsorship and your membership. Thank you so much.
Thank you. It was a plate.
It was a plate, yeah, we don't want to get into that.
Okay, so now I'm going to ask Mike to pull the raffle ticket for the door prize. They were gracious to raffle off a gift card.
Blue ticket. 338-9445.
Oh, congratulations, Patrick. I have it right here. And then next we have is the 50-50 raffle, and I'll ask Mike to also pull that, and that's for the 50-50 raffle for the Virginia Eilers Scholarship Fund. It's 105.
White ticket. One. Oh, shoot. One off, but I think I didn't pull out the other one. 122-230.